Hello and welcome to another episode of Full Court Finance here at Zacks. Today we're looking at whether or not you should consider buying Zoom video stock before its upcoming earnings next week. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So quickly off the bat, before we jump into Zoom, it's always worth remembering where the market is in general. Stocks jumped today on the back of some news that the Trump and Biden team would start working together on a transition plan a little bit more. So that was the big news on Wall Street this morning. So you saw the Dow and the S&P 500 and the NASDAQ all climb about over 1% through early morning trading. And then if we look back over the last several weeks, we know that Wall Street pushed stocks up to new highs after Pfizer's big COVID-19 vaccine announcement. Then we had that positive news from Moderna and others more recently. Prior to that, the market ripped higher after the election, as investors are apparently pleased enough with the likelihood of divided government in Washington. And since then, since all of this positive news, we had Goldman Sachs and some other big analysts on Wall Street from the likes of JP Morgan send out some bullish notes to their clients, especially if they see a vaccine actually being distributed at some point in 2021. So they're more positive on 2021 and 2022, given this vaccine news. With that said, there's no guarantee that this vaccine is going to be out necessarily anytime soon, or how many people are going to be willing to take it. So we'll see what that is, and that plays into the hands of Zoom video. So the market itself is still doing well. It was doing well even before this vaccine news. The earnings for Q3 and Q4 and 2021 were trending heavily in the right direction. And with this accommodative interest rate environment, stocks were poised to do well, even, as I said, before this vaccine news. And the vaccine news does play into Zoom video, and the stock has not done particularly well over the last month or so because people see it as more of a coronavirus play. But we're going to jump in to more of the stock ahead of its third quarter fiscal 2021 earnings release, which is due out next Monday, November 30th. So the first Monday after Thanksgiving, and the last day of November before we hit December, which is crazy to even say. So we're going to take a broader look at Zoom, see what to expect going forward, and then sort of where the stock is heading into its report next Monday to give people a better sense of if they should consider buying what was at one point the big standout of the coronavirus market, especially in the first sort of 3 or 4 months of the lockdown period. So with that said, Zoom was clearly thrust in the spotlight early on in the pandemic. People and businesses quickly searched for ways to connect with coworkers and friends during that stay-at-home and social distancing push, which is cropped its ugly head up again more recently. Zoom's cloud-based video conferencing platform proved to be a hit because it was simply easy to use, and it kind of proliferated from there. It became something you just said, let's Zoom, maybe even if you weren't using Zoom. And even if those Zoom calls between friends and family fade, which they certainly did over the summer, they might be popping back up again as we head into the winter, as you see these cases on the rise. So this could be a positive near-term boost for Zoom. But more than anything, Zoom's revenue comes from its subscription-based paying customers, and those are businesses and schools and stuff who are using its offerings nonstop in this current remote work and learning environment, which really could be here for much longer than people assume, even if we have a vaccine at some point in 2021. Because the possibility of businesses remaining in their current remote capacity seems pretty realistic, especially for many professional services firms in big cities where you have public transportation and elevators and all of that hampering reopening plans. And especially if people have become a little more accustomed to it and things are going as quote unquote smoothly as they could be, maybe you just see companies in the long run permanently cut back on some rent and commercial real estate expenses. You already have people leaving the San Francisco Bay Area. Some of the big tech companies are saying they're committing to working from home from an extended period of time. So you have a lot of those employees going to different places in the American West. So you're already seeing sort of an exodus out of some of the bigger cities. We've seen what's going on in New York, and more people are just trying to find some space amid all of this. So this could be here for a while. Excuse me. On top of that, Zoom offers the ability to, and it goes hand in hand with this, to scale down on travel, which it was promoting long before the pandemic. It was one of their big pushes about helping companies be more green. And the pandemic could certainly help normalize less business travel. Business travel has been cut out almost completely for most people. So that could be another selling point for Zoom long term. And we should note that the Zoom just went public in April 2019. And as I said, it was highlighting that factor at the time. And it's also vital to remember that the company was doing well in growing well before the pandemic. Millions of people were forced to work from home, and this has obviously helped them a lot. But if we look back to the fourth quarter, so this is the fourth quarter of last year before the pandemic was playing any role, their revenue jumped 80% for the period ended on January 31st, and their full year 2020 revenue, so they're a year ahead on the fiscal year cycle, was up 90% to about $623 million. So they were doing really well even before that, and then obviously things changed dramatically. So the company then blew away our Q1 estimates in early June. Sales were up 170%. It showcased to Wall Street that it was able to add these paying customers. So customers contributing $100,000 in trailing 12-month sales jumped over 90%, while its customers with more than 10 employees soared 350%. So it was really showing it was able to get these business customers that are going to be the lifeblood of its business going forward. The firm then announced over the summer, so in July, that it was rolling out its what it calls hardware as a service. That's that buzzword, as a service, which will make its Zoom Rooms and Zoom Phone more accessible. This is the basic pitch here, is that it's allowing people who are on Zoom calls all the time, or if they have to give presentations from their home office or wherever they're working remotely, have it be a little bit more of a professional environment than just say your laptop or your home desktop. They're partnering with a company to do that, so that could play a role going forward as well. So then if we look to their Q2 results, which are their most recent results that we have at this point, the company's revenue climbed a whopping 355%. So massive growth in the second quarter. And that accounts for the whole beginning of the coronavirus pandemic. Continue to add more customers with 10 or more employees. That was up 460% to nearly or roughly 370,000. Its clients bringing in over $100,000 in trailing 12-month revenue were up 112%. So just that massive growth you saw. And as I've mentioned a couple times, but it's really worth stressing, these are the clients that they need to continue to use this going forward. This also helped the company crush our earnings estimates and see its adjusted earnings grow in a big way. And we should also note that Zoom has boosted its cash position. It raised its guidance last quarter, and the CEO and company executives are very positive going forward. Obviously, you're often going to hear that from an executive no matter what's going on, but they certainly have reason to be positive and optimistic about the situation, even as things, quote unquote, return closer to normal. But as I mentioned, the situation in parts of Europe and the United States are trending in the wrong direction, especially in some of these bigger cities. So you could see this work remote environment lasting for a very long period of time, even if things do return more normal, especially in, as I mentioned, once again, those professional services fields. And then we should note that in late October, the company announced a new end-to-end encryption that was now going to be available for all of its users globally. And this is free users and paid users for meetings up to 200 participants. So early on, when they did insane business that they weren't expecting because everyone jumped onto their service because of the pandemic, there were some issues with security. So they had slowly addressed those, and obviously people weren't worried because they were jumping in en masse. But in late October, you saw them roll out this end-to-end encryption service or offering that's free to all of their users. So with this in mind, we're going to now look ahead to Q3 for what we're expecting. So it's worth reminding they did 355% revenue growth last quarter in the second quarter. So looking ahead, we're calling for another 317% growth this quarter, and we're calling for its adjusted earnings to climb from 9 cents per share in the year ago period to 75 cents per share. So that's over 730% growth. And we're calling for 282% growth in the fourth quarter, and with its adjusted earnings expected to climb over 310%. So for the full year, fiscal 2021, their current year, its revenue is expected to climb over 285% from $623 million all the way to $2.4 billion. So just a massive, massive jump. And then on the bottom line, we're calling for a 611% climb from 35 cents per share to $2.49 per share. And then on the positive note, and this is what obviously it's going to be hard to, they're not going to be able to recreate another 285% growth because at this point, most people who have needed to sign up for Zoom that's a business have already done it, since it wasn't like you could slow out your work remotely till just now. You already did it. So we're calling for another 32% growth in 2022. And obviously that sounds like a lot less than 286% growth. But what's worth noting is that they would do about $800 million more in sales next year. So they're expected to get all the way up to $3.17 billion or $3.2 billion, which is way more than they even made in all of fiscal 2020 when they made $623 million. So positive growth on the top line. We're calling for a little bit of a slowdown on the bottom line. We're calling for about a 3% year-over-year decline from what we're calling for this year, but this massive growth is just going to be hard to keep up, and they're still heading in the right direction. And then if we look overall, the company's earnings consensus estimates are up really big from before they reported their Q2 results. They've stayed pretty much the same over the last 30 days or so, so not much movement from analysts. So with this in mind, the company has also easily topped their bottom line estimates for the trailing 4 quarters. So the last quarter, they beat by 100%. The quarter before that, they beat by 100%. The quarter before that, they beat by 115%. And the quarter before that, they beat by 200%. So history is not always a guide, but they've crushed our bottom line estimates for the trailing 4 quarters, which is certainly a positive sign. And overall, so over the last year, we're not going to look at the stock price movement. So over the last year, ZM stock is up about 475%. This compares to the internet software market's 85% climb. So they've been on a massive run. As I mentioned, the last month has not been the best for the company. They are down about 18% in the last month compared to the internet software market's about 4% climb over this period. And the market in general has gone in the positive direction as Zoom has taken a little bit of a hit. And as I mentioned, that has a lot to do with positive vaccine news. People are thinking maybe we won't be needing Zoom anytime soon. But as I mentioned, some of those numbers and what we've talked about, they could continue to be trending in the right direction in terms of that growth. We should note that they fell under their 50-day moving average earlier in the month. They have fallen below their 50-day move average before. They fell below that just briefly if we look back into mid-August. So we should also note that the stock is trending upward in the last week or so. So positive news on that front. So as we mentioned, the consensus estimates have not changed recently. So this helps Zoom hold a Zacks rank number 3 hold at the moment. and it currently trades at about a 25% discount compared to its records from earlier in the year, and it's trading at about $430 per share. That might be sticker shock to some, and it's certainly, its valuations are still a massive growth stock. It has an A grade for growth in our style score system. And obviously some people might want to just take a step back from Zoom and see how their guidance comes in given this vaccine news. But as I mentioned, it's still so up in the air. It's not like any companies can really commit to, we're going back to work. Here's our plan, because you just don't know yet. So I tend to be a little more bullish in the long term and the near term for the company. I just think that maybe they're not going to be doing this massive growth. Well, obviously not going to be doing this massive growth, but I think that this coronavirus has certainly made companies reevaluate how they want to do office space, maybe save some money, have maybe some employees come in 3 days a week or 4 days a week, or 2 on, 3 at home, something like that, just to cut back on commercial real estate expenses, cut back on travel, things like that. And obviously you never know, people, once things get back and there's the health is trending in the right direction, maybe the vaccine works, that you'll see people just be dying to get back to work and getting back on the train and getting back to work. So we'll see on that end. But as I mentioned, the numbers are what they are. We're calling for massive growth this year and next. The stock sitting at a pretty significant discount compared to its recent records. So maybe some people want to take a chance on Zoom on the dip. And obviously, you never know in the near term, especially trading it around earnings. Who knows what they're going to do, obviously. But I certainly think it's worth diving a little deeper if you're considering Zoom at the moment, since it's fallen out of favor a little bit recently, especially as the market's trended in the right direction with this positive vaccine news. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.